Hi, my name is Eric Earley. I'm an attorney here in Las Vegas. And the problem is you just got a bill from the IRS for $70,000. You call me up and you say, Eric, what can we do about this? And how did it happen? Well, there's probably not much we can do about it after the fact. That's why we do tax planning. We do things before the foreclosure or before the short sale so that we can avoid this tax. But here's what happened. You either got a foreclosure last year or you did a short sale last year and you didn't realize how much of a taxable event this is. So let's talk about the rule and then the exclusions to the rule. Number one, you got to realize that anytime a bank forgives more than $600, they are required by law to report this to the IRS. And the IRS says that's ordinary income anytime someone forgives you a debt. So they're gonna get a form 1099-C. You'll get a copy of it. The IRS gets a copy of it. The C stands for cancellation of debt, and it is ordinary income. Unless you fall into one of these exclusions, then you're going to be paying the tax on this. So let's talk about the exclusions. Not all of them, just the ones that I see people screwing up all the time. Let's talk about the primary residence exemption. Number one, of course, it's got to be your primary residence. Number two, the money must have been used to purchase the home, or it could be a refinance, but it has to be a refinance of a purchase, or it has to be a home improvement. If you put a pool in your backyard, you did a new roof, you remodeled your kitchen, that's great. That qualifies. But to the extent that you use the money for something else, paid off your credit cards, no, that doesn't qualify. You went on a trip around the world and then refinanced into the next loan, no, that doesn't qualify. To the extent you use the money for anything else, had a guy that bought another home with a home equity line of credit, no, that doesn't work. It has to go back into your home. It must be a purchase money mortgage used to purchase your home or improve your home where you live. Anything else? Bam, does not qualify, okay? You got to remember that. I see this screwed up all the time, and people are getting surprised with a huge tax bill because they don't qualify for this. So if this doesn't work for you, what's the next one? The insolvency exception. Now people screw this one up too. Here's the insolvency exception. Basically the IRS is saying, okay, you have a negative net worth. Take all your debts, add them up, all your assets, add them up, and if you have a negative net worth, a negative number dealing with what your assets and debts are, meaning you subtract your debts from your assets and you're just worth less than zero, I'm sorry to say. But the IRS isn't going to kick you when you're that far down. They'll kick you when you're down, but not when you're less than zero. Unfortunately, this exemption only works part way. If the debt forgiveness gives you a positive net worth, it only works below zero. Once you come up above zero and you have a positive net worth, they're going to tax you to that extent. So again, here, let me show you where people screw it up. Add up all your debts, personal loans, student loans, credit card debt, the debt on the home, of course, and then add up all your assets. Fair market value of the assets, right? Not what you paid for it, but what is it worth today? What could you sell your furniture for? What could you sell your car for? You got to get the fair market value. But where people screw it up is they forget to include their retirement accounts. They don't realize that the IRS counts your IRA account and your 401k account as an asset. Of course they do. It is an asset. You could cash it in if you wanted to, right? So these are assets. You've got to count them for purposes of the insolvency exception. And again, you total everything else up. You subtract your debts from your assets. If you end up with a negative number in the end, you do qualify to some extent for this insolvency exception. But it's a two-step process. You got to look again after the debt forgiveness happens. You pull the debt out, you pull the house out as an asset, and are you still insolvent? Or did it bring you up above zero so that you have a positive net worth? If you have a positive net worth, they're going to tax you to the extent that the forgiveness gave you a positive net worth. Just got to remember that. That's as simple as it is. So if this one doesn't work, if this one doesn't work, let me tell you where people screw it up on this one. Bankruptcy can solve the problem, but not after the fact. If the bank already forgave the debt, that's a taxable event. It's happened, and you cannot discharge the tax in bankruptcy. That's not how it works. You have to prevent the taxable event from happening. The way you do that is you discharge the underlying debt in bankruptcy. What does this mean? It means you got to do, if you're going to try to get rid of that $70,000 tax, you got to do the bankruptcy before the foreclosure. You got to do the bankruptcy before the short sale. If you do it after, and you got, say, Bank of America, they're being very good as far as forgiving debts right now. We get them all the time with full deficiency waivers as far as short sales are concerned. And if that's what happens, you've got a nice, easy debt forgiveness, well, guess what? You just got nailed with the tax. If these ones don't work for you and the other ones in the exemption don't work for you, this might be your only chance. And why would the insolvency one not work for you, but the bankruptcy one does? Because in bankruptcy, you get to keep your IRA account, right? You get to keep it up to $500,000. Well, that means you're not insolvent, not really. But bankruptcy works for you because you've got an exemption from the law. You get to keep your IRA. You get to keep your vehicle that has $15,000 of equity. If you've got a homestead, maybe your rental properties are screwing you up, but your homestead, you own it outright. Maybe it's worth $500,000. You're certainly not insolvent. You've got $1 million worth of assets. But you get to keep them in bankruptcy because those have explicit exclusions for you to keep while in bankruptcy. So bankruptcy can be a good thing. We usually look at it as a last resort. But when you're looking at a $70,000 tax bill, hey, maybe you need to do this before you do the short sale. Now, don't give all hope up on the short sale, though. There are a lot of good reasons for doing the short sale after bankruptcy. That's right, after bankruptcy. So, I mean, there are good reasons for credit, for maybe even getting some money back from the bank. There are reasons to do short sales after bankruptcy. I just want to make that clear and reiterate it. But as far as the tax is concerned, it's a timing issue. You got to file the bankruptcy before the debt forgiveness happens. Because if you do it the other way around, you've already been taxed and you can't discharge the tax in bankruptcy. Now, if you want to do some pre-bankruptcy planning to maximize your exemptions, you need to come and talk to an attorney to find out how to do that legally. And we do allow it in this federal district. So, and we're talking Nevada. We're not talking any other area here. Only Nevada law. But you can give me a call at 702-727-8384. We can talk about the legal pre-bankruptcy planning, pre-short sale planning, pre-foreclosure planning that is allowed in this district. Give me a call. Again, 702-727-8384. Thank you.